Good evening, members. Warm welcome to all of you for the study circle meeting on the fresher session on TDS and TCS. Amongst us, we have a speaker, CA Sanjana Dawar, to present the paper. I request the chairman, CA Manjunath M. Halur, to escort the speaker and greet her with the floor. Members, I do have a privilege of introducing the speaker. This is the very shortest profile that has been given to us. So, CA Sanjana is an Associate Director in Deloitte Bangalore office and has over 9 years of experience as a client service professional. Sanjana expertises in the field of Indian tax and international taxation and in compliances and advisory matters. Sanjana has experience in representing matters before appellate tribunal, authorities and service clients in the customer business as well as technology business. That's it. Thank you. We present before you Sanjana. I don't know.
Good evening, everyone. I'd like to first take this opportunity to thank ICI for letting me stand here in front of you. Now, the session today that we have is essentially on TDS TCS. It's something that I'm sure all of us have gone through enough. I've tried to keep it as practical as possible and would request if we can make it as interactive, and in case there are any questions or any viewpoints, we can discuss it. So that's the objective really. While we get into the technicalities, let's start off with why TDS, right? So what is the significance or what is, rather the scope of what we do and why is it that TDS is important? So if we look at the direct tax collections in India, we are all aware that they have been on a rise in the past few years. As of 23-24, for the data that is available and published by the government, 56.72% of the collections are contributed by direct taxes, which means it's, in that sense, higher as compared to indirect taxes. Now, when it comes to the indicator of the tax to GDP ratio, for the financial year 23-24, it hit a 24-year high at 6.64%. Again, giving an indication of how potent these collections are for the government. Also, when we look at the CBDT data of a year-on-year increase, what we see is that as of the data that's published as of February, approximately 19% is the increase of the last year. And the data that we had for the financial year 23-24 stated that 50% of the direct tax collection is TDS, which means that the other taxes or the corporate taxes or what we pay as personal tax comes in later, but 50% gets collected in advance. Of course, this number would be interesting to see in the current year, given that there have been a series of amendments reducing tax rates. But overall, we do not see we don't anticipate a significant decline. So that's the contribution of TDS when it comes. Now, when it comes to say a tax deducted as source as a subject, of course, it's when it was introduced earlier, it was very specific in terms of the payments that it covered. So, very limited, say, interest, contract payments, professional services, etc. One trend that we would have noticed in the past few years is that from 2020 onwards, the scope of TDS has expanded drastically. And as we stand today, there are fewer payments that fall out of the bracket of TDS and a majority which do. So today, say, all of us as professionals would agree that if there is a payment that comes to us for, evaluating TDS liability, there is a very likely chance that TDS would apply. And there is a fewer chance to sort of say that this does not, attract TDS. So that's the sort of scope that has expanded. Of course, what has contributed to this is also some of the emerging business models. So, winning from online games subjected to TDS, then there was e-commerce that saw a boom, that's where it came in. Virtual digital assets, benefits and purpose, it's again a very interesting one. Then goods was brought into the scope of TDS, started with 2060-1H, then we had 194Q, and as we stand today, 2061H is proposed to be abolished from 1st of April 25, so we would have 194Q that should govern this now. When we look at the scope of TDS, what is it that we have as references? We have the Act. That's our gospel. That's the first thing we go to. We have circulars and notifications guiding us through, what are the payments to include, exclude. Of course, some of them with the view to remove difficulties. Then, of course, if we have non-resident payments, we venture to the double taxation avoidance agreements, and we have judicial precedents where, based on principles, we determine as to what is the nature of certain payments. So that's the scheme of the levy. We have two chapters. We have a part that talks about TDS. We have a part that talks about TCS. Needless to say, in the proposed bill, this is of course intended to be much simpler. It will all come under one section, or say a few sections as tables. But by and large, the scope of TDS does not seem to have changed even in the new income tax bill that's proposed. So we have a gist of the provisions. We'll just walk through this. I think what we will also do is we'll just look at some key amendments and certain points to note here, and we'll come to the practical considerations. 192 talks about TDS and salaries. We are all aware. One characteristic feature of this section is that if there is a shortfall in TDS on salary through the year, that it can be made good up to 31st of March. So then, as such, there is a view possible that there shouldn't be an interest implication if through the year the employer has excess or reduced taxes with them. One change that was brought out here was that, of course, up until the past years, there was, the option to give it details of other income under other heads, which still continues. If there is a loss from income from house property, that can also be provided to the employer. And if there are any other TDS payments under any other sections also, that can also be furnished to the employer, and the employer then is mandated to withhold taxes only for the balance liability. Now, one interesting point that comes here is that, say, if I as an employee had multiple other sources and I missed paying advance tax, then by just reporting it to my employer and then by asking him to do TDS under section 192, does that absolve me of my liability to have complied with the payment requirement through the year? So this is one practical issue that could come in with the leeway that you could ask your employer to factor other TDS under other sections and then determine the withholding tax liability. We have premature withdrawal of EPF, then we have interest on securities at 10%, we have dividend at 10% also. There has been, of course, a slight increase in the threshold. With effect from 1st of April, it's expected to become 10,000. One point here that, sometimes we end up sort of skipping is the fact that when we say dividend here, it means all forms of dividend under section 222, which means that if there is an arrangement of a loan or advance to a shareholder or for his benefit, and if you're trying to take a view that it is not deemed dividend because for whatever reasons, because it's in the course of a trade or it's for not his benefit, and it's not really intended to be given to him as a dividend, while that position holds good for his income, there is a position that then implicitly is adopted for TDS also, because if there is a deemed dividend for any reason, then there is a counter withholding liability on the employer also. So that's something that we can watch out for when we look at 194 liability. For interest, other than interest on securities, the rate is 10%. There has been a slight increase in the threshold, which is proposed with effect from 1st of April. Then for winnings from lotteries, crossword puzzles, winning from online games and horse races, there is a 30% withholding. For B and BB, while this was 10,000 per financial year, it's proposed to be increased to 10,000 per transaction. So, I guess that's one thing. Now, we move on to payment to contractors. Now what this section really talks about is payment in respect of work. Sometimes what happens is that, if we see an arrangement and if we see that it is, say, governed by an oral or a written contract, we tend to lean a little bit more towards 194C. But really the key question is that the activity there has to be that of a work. Work is defined inclusively, which means that apart from those items that are listed in the section, there could be other items that would constitute a work also. Illustratively advertising, illustratively goods carried, supply of labor, manufacture of a product for customization of the customer, provided the material is either given by him or by his aide. Now, the amendment, the fact that the material could be procured either from the customer himself or from his aide was brought in basically to plug in a loophole, because what we would see is that parties would try to, instead of providing the material themselves, they would get their aid to supply it and then take the benefit or move the transaction out of 194C. Of course, this was prior to 194Q. So to plug that, AEs and the company both are covered. Then we have 5% on insurance commission, 15,000 threshold proposed to be increased to 20. I think then commission on sale of lottery again is 2%. 194X commission or brokerage has been brought down from 5% to 2% effective 1st of October 2024. Again helps us, in that sense, I think one development that has happened is C, J, technical and 194H has become 2. So probably that, the classification litigation that we would have, saying which section do I take it to or how do I structure my transaction, gets settled out because all three of them become 2%. In commission, the key item obviously that we look at is it needs to be a principal agency relationship of sorts, also in substance, even if say, by a form of form, but also in substance. And it needs to be in relation to a buying or selling of goods. So that's provided in the section itself to say that when I act on behalf of somebody else in the course of buying or selling of goods is when 194H gets triggered. We have rent then. Plant and machinery, land and building, 2% for plant and machinery, 10% for land and building. The threshold here is proposed to be increased to 50,000 per month. Then one section that impacts us more as individuals is 194IA, where we have a 1% withholding on, procurement of a movable property. So 50 lakhs is that, something that, as individuals we have to be careful of. And then we have 194J, where we have a 2% and a 10% section. 2% is for technical services, 10% comes in for royalty, comes in say for non-compete, comes in also for professional services. Professionals are defined, those professions which are defined as such for the purpose of section 44A. Some illustrative cases, profession of accountancy, profession of engineering, company secretaries are also included there. Again, very specific in terms of the list. So, essentially when we look at any invoice and we say which section or rather which rate do we swing to, one reference that we can do is we can refer to the list of professionals as such that is provided and see if we are falling out of there is when we go back to 194J 2%, but then the first check has to be whether we fall under professional category. So that's where we have 30,000 is the threshold that used to be there, proposed to be increased to 50. I think then we have LA for compulsory acquisition of a movable property, again not something that we've seen as much. Then for payment of certain amounts in cash, we have a withholding. So of course if the withdrawal is say in excess of 1 crore or 20 lakhs to 1 crore, in certain cases then there is a withholding of 2 to 5%. Section 194O provides for tax withholding on transactions facilitated through an e-commerce platform. This rate was 1%, has become 0.1%. Again, this was an ask from the industry as such to say that, in a retail trade, especially when it's on a platform where the market is very competitive, the assumption that the overall profitability would be as high to be able to absorb a withholding tax of 1% is where this was leading to challenges. And it's been brought down at 0.1%. 194Q is for sums paid for purchase of goods. One thing that is more peculiar here is that 194Q triggers for the value above 50 lakhs, which means that like all other sections, once we checked out the threshold, we look at the entire transaction value. For 194Q, after we have exceeded the threshold, we only have to levy the tax for the differential balance. 194R applies on benefits or purposes. I think this is again something that has led to a lot of speculation and evaluation as to what is it that can get covered potentially under 194R. While it reads benefits or purposes, I mean, of course, we get into as to what are the ramifications of it. 194S on transfer of virtual digital assets. 194T was introduced from the Finance Bill 2024, covering payments made to partners or partnership firms. And we of course have 195 for all non-resident payments. A little bit of a deep dive into section 195, it talks about when a payment is made by a person to any non-resident for income which is chargeable to tax. And this transaction, or 195 also applies if the transaction is between two non-residents but the income is taxable in India. For example, if there is a sale of shares which is of a company incorporated in India, but if that transfer is happening between two non-residents, even then 195 would have to be looked at. The rates provided here are also from say 115A, interest, dividend, royalty, FTS. It was in the 10 to 15 range. It has been it is increased to 20. Other income has gone to 35. It was 40 plus surcharge and cess, which has become 35 for companies. So that is one change. I think one point to note is that because under the domestic tax law, the rate of withholding has become 20. Right? If the treaty provides for a lower rate of a 10 or 15%, then there may be a requirement to file a tax return of income if the withholding is done at a lower rate and if the income is offered to tax at a lower rate. Because the exemption that is provided under 115A, which says that if the taxes are withheld at least at the rate prescribed in that section, excludes the non-resident taxpayers from filing tax return, then sort of becomes redundant because most treaty rates are lower than 20%. So this is something that comes up after this change. Again, one of sort of the key items that we see in 195 is the request for lower withholding certificate. So again from two aspects. One is from the perspective of the person deducting tax, can make an application to the tax authorities if he is of the view that there is a part of the sum which is not chargeable to tax. Normally, if the entire amount is exempt, then what we've seen is practically we take a view that in that scenario we can apply the Supreme Court ruling in case of G and say that I did not have to get 195 certificate. We normally see tax authorities coming back and say that if you thought that this sum was not chargeable to tax, why did you not apply for an LDC or this certificate? To which of course we can say that the entire sum was not chargeable to tax. Even otherwise, in a scenario where if the buyer and the seller are related parties and if they are transacting and between themselves if they are comfortable to apply tax on a part of the amount, practically we've seen them taking the benefit of the reduced withholding without going in for a 195 certificate. So the form has to be filed electronically in 15E and there are certain items that are to be taken into consideration by the tax authority. So, sir.
But when you file the return, when you're going for a lower tax without the FTC certificate, the return will not get accepted. Because you have to give the FTC number, only then it will accept it.
Sir, I'm mentioning the income tax return. So what I'm trying to say is that, say for example, if you have a transaction between two related parties, non-residents, and if they are, or one resident, one non-resident, then they are comfortable to take a position that I don't have to do a 35% of the gross sum. Because I know you and I know what your tax liability is, then you can still look at taking the reduced rate based on whatever your calculation is. If it's a capital gain, then you do sale price minus cost at 12, multiplied by 12.5, or for whatever reason. And you don't necessarily have to go into a 195 too, because it's what we've practically seen is it's a slightly lengthier process. And tax authorities at this stage at least tend to take a more, like a conservative view, because they would not at an assessing officer level, want to tell you that, go ahead and don't do withholding.
Well, that's correct, but how do you find the return? I have to put the correct rate. If I'm giving a lower rate, then I need to put the FTC. you're talking about a low tax deduction rate.
Certificate for 195, yes sir.
Right?
Yes,
So
sir.
then the return will not get felt. That's my point.
No, so practically we have seen this coming in at a.
You're talking about the ETDS return.
What?
You're talking about
Yeah, I'm
the
talking
ETDS
about the
return.
TDS.
He's talking about the ETDS return.
In the ETDS return you're saying, sir? So there I think if we mention the amount which is chargeable to tax, I'd still be able to get it. No, I would have to figure a work around it. But sir, I mean, what we've also seen in case of non-residents is that you don't necessarily have to go and get a 195. If I mention the amount chargeable to tax, I mention the tax on it, then my, when the other party is filing the return of income, they can furnish the entire computation. It will be like how it will be a slightly tricky position. The more safe you will be to do a gross, but then this process can be much lengthier.
Even in case of sale of immovable property by an NRI to local person, in that case, while making a payment, the net amount you can deduct on the net amount.
And so NRI to local person you will be applying the 194 IA.
195. 195. He is NRI now.
Acha, okay, so you're making the payment.
Immovable property.
Huh.
So, okay, 194 IA for immovable property. What
Okay.
is the tax on which value I have to deduct?
No, there I have to do gross only. Here because it says the section also says some chargeable to tax.
So, because it is 195, okay.
Yeah. So when it is a sale, when you're paying to a resident and if you're looking at a immovable property sale, you have to.
Paying to NRI.
You're paying for, then you can apply 195.
195. So,
Correct.
on net value I can deduct.
Correct. Yeah. It's because that income chargeable to tax would still be that low.
If the person invests under the other property under 54F, then we
No, because
That makes
actually no, that will be a very aggressive route to take in my view because then it's contingent. At that time he wouldn't have, unless that's what you're saying, that's one. And practically, if I were to advise between third parties, I'd say you may not have visibility over what he's investing, whether he will actually keep it in that account for that long or will he withdraw it from the capital gains account scheme. So you might as well do it, if not at the gross rate, but at the capital gains that you're comfortable with. Then 195 we provide for application for grant of certificate authorizing receipt of interest, one and other sums chargeable to tax. This is to be done from the perspective of the recipient of income. The previous one is from the perspective of the deductor. So here also for a reduced rate an application can be made and obtained from the tax authorities. Now 197 comes in. This is applicable for both residents and non-residents. This is an electronic application that has to be, an application has to be filed electronically in Form 13. The criteria that has been provided in Rule 28A for the purpose of applying for this is, existing tax liability of past 4 years, any demand as such, or TDS and TDS credits available. And there are two ways that this can be applied. One is in case the client has details of all parties with estimated receipts and say their TANs, then the application TAN wise can be furnished. If the number of parties are expected to be more than 100, then there is an option in Annexure 2 of Form 13 where a consolidated sum can be taken, which means say that if I am the person applying and I am the recipient, expected to be the recipient of income, I am expecting that under 194J I am going to receive say 100 crores. If I have a party-wise breakup, I have the option of furnishing the TAN and the details of parties and estimated receipts, or I have the option of applying one consolidated line item of 100 crores under 194J. But the key condition is that I should have at least 100 parties to go under that option, which means that I can distribute it to my parties through the year, and I will have to keep a track of the limit of the lower deduction certificate to ensure that it is not getting overutilized. Normally a challenge that comes in NBC. So
in this case, the deductors, how will they determine?
Exactly. They cannot. You're saying in the second consolidated one, right?
Right.
Actually, no. So unfortunately, there isn't an answer to that. That is an issue. So then that can be like monitoring between the customer and the other party to say that use this sum for this amount, and don't use it beyond. Otherwise, then you can probably say that then if there is an interest implication that you have to
Because
pay.
there could be a possibility where the deductor will say, I'm not comfortable, I don't know whether you have the limits or whether they are exhausted.
Absolutely.
And they might still go for a higher rate, right?
Absolutely. Please, so this also is something that we have seen. So typically where this issue also comes is where you are changing your approach. So say up until Annexure 2 was validated, if there was a TAN-wise application and after the Annexure 2 enabled, some parties sometimes try to take a more lenient view, let me go and apply consolidators where deductors come back and say, no, I don't have comfort. But so the certificate will be valid, that shouldn't be an issue, but then yeah, that's something that will be an additional effort to track and to convince them to use it and to also have 100 parties. Because I would think if you fall short there, you go back the next year and if you can't demonstrate 100 parties, then it will be a good time trying to get it back actually.
Yeah.
So yeah.
It's a little impractical.
A little, yeah. For businesses where you're more unsure of, it's more like a B2C or too many, B2C of course wouldn't have it, but you have like much smaller vendors where you don't know what could it be is where it helps, yeah.
And they wouldn't have the wherewithal to take that risk.
Correct.
I don't know about your limit, I don't want to take the risk because tomorrow I'll have a 201 limit.
Correct. But then if there's a 201, then they can, of course, there if you can give them comfort and you recover it from me, then I think it will still work.
Again, it's a long
It's a long, yeah. Practically, unless the monitoring is happening from the system, like you're saying, they don't have comfort, that's true. Coming to 206 AB, which talks about higher reduction in case of specified persons. Specified persons are persons who not filed their income tax return for the previous year, and where the TDS exceeds 50,000. The tax withholding has to be done at a higher rate, twice the rate of the relevant section, twice the rate in force, or 5%. This section, thankfully, is proposed to be abolished from 1st of April because it was a lot of monitoring also that it was causing. And one challenge that we would see here was that the department had a mechanism to track whether this person is a specified person as on the date of deduction. But for the party withholding the tax, he can't really practically track it on a daily basis as to when does this person stop being a specified person, etc. So that was becoming a bit of an issue, except in some, especially in some unorganized sectors. But fortunately, this section now will get repealed, so doesn't apply. We have 206A like we used to. The counterpart for TCS also was there, also proposed to be abolished. So this section should be done. Gist of, I think TCS, I think this has largely been in line with what it was. There is, a change in a couple of rates here. Line 3 and line 4 timber obtained under forest lease. Here the rate is proposed to be reduced from 2.5 to 2. And timber obtained by any other mode under the lease also, the 2.5% is proposed to be reduced to 2. 206C1F, which used to apply on cars in excess of 10 lakhs, is also proposed to be extended to certain luxury goods that the department should notify. So that's an amendment that will come in. 206C1H is proposed to be abolished, so we will just have an example. Sorry.
206 scrap. In case of production, if I produce some scrap and selling, then I have to collect the TCS.
Correct.
So, if the person who is buying is again using for production, then no need to collect the tax.
You see, if it's only at the first stage and if it's not at a recurring stage, is it?
Yes, first stage. I am a manufacturer. I am manufacturing certain products. I produce some scrap.
Correct.
After producing of scrap, if the buyer is giving some disclosure that he will be using for further production or selling,
okay,
then no need to collect the tax, correct? There is some exemption to my knowledge.
No, what I know of it is that if it is in the course of manufacture, you have to do it. But in your case, you're saying in the second leg, is it for trade then or is it again? Yeah, because then the processing is not there.
Yes.
Then on that basis, on the second stage, it will not come. But you will still have to do it.
Okay.
No, but where the person is using it as a foundry, where foundries are taking it as an input, they don't have to do the scrap TDS, right? Because they'll be using it in manufacturing. So someone who's selling it as a scrap, but since that scrap is going to be used as an input for their manufacturing, they have an exemption. I think that is
Yes. Yeah.
But in that case, will 261, I mean, at least 194Q.
1H now doesn't apply.
194Q will apply because this is not getting applied.
You'll have to look at it, yeah.
No,
And
that
that
is
is
not
also
the goods, no. That
So
is not
scrap-
the goods, no.
So scrap is also considered.
Scrap is also considered.
For entire value.
About 50 lakhs if you fall there. Yeah.
Usually, practically, the scrap value will not be much to money.
Yes, correct, correct. So in some businesses we've seen them
So
quite high.
it depends. Like I've done audits for newspaper, the ready sellers who go into crores. So it all depends from the. Sorry, I was just adding to what you were saying.
Yeah.
Rabi sellers also it goes into crores. So what is one man gold is an
Yeah.
like I say.
So we could say
But my question, ma'am, in which scenario where, see, in every case, there will be some input for an exchange. Say, for example, I will produce some scrap, and if the person is buying, then it will be an input for him.
correct.
In what stage that scrap will be applicable, I did not find any scenario. At least in my, I was limited to exposure only in single industry. So
So you're saying in the second stage, if it is getting used as an input again, then
Then
you are
an
getting
exception.
correct. But 194 you will still have to test. No?
194 keeping aside, say for example that is less than 50 lakhs, that limits are not touched.
Correct.
In that case, see if I am selling, then in any case it will be input for every person.
No, actually, so we have scenarios where no, it doesn't become. So after the first stage, then how would it becomes like how would I say, like a goods, like a substandard product for consumption later on, say for end customers. There, then it doesn't become, sort of remain as an input. In fact, we have scenarios where it is a scrap of sorts, but it's a complete trading. Also, like she's saying, then if it's not used as an input, then you would still have to continue to do it.
For trading also it cannot be treated as input.
We don't. Yeah, we go to 2061 actually. Sorry, I think we missed. 2061G has been amended. I think it become a little difficult to implement. So this came on liberalized, payments under the liberalized remittance scheme. Now this, of course, when introduced, it went through certain amendments. So finally, what's proposed to take effect from 1st April 25 is the fact that if the LRS is for education and has been financed by a financial institution, then there is no TCS that will apply. For medical treatment, it was nil up to 7 lakhs and above that it was 5. That 7 is going to become 10. It still applies though. LRS for other purposes, it was again nil up to 7 lakhs, 20 above that. The thresholds there have increased from 7 to 10%. So that's unchanged. That's some implementation. And the fact that if it's a loan that is being taken from a financial institution for educational purposes, then TCS does not apply. So these are the steps that come in for the purpose of sort of complying. So we have the first step of deduction collection of tax, followed by deposit, followed by filing returns, followed by issue of TDS certificates. The due dates are here. For April to February, 7th of the next month. For March, 30th April and 7th of April. For TDS and TCS returns, for all quarters otherwise, it is the 31st of the next month. For March alone, we get May because the due date also becomes April. For the TCS return, the 31st May becomes the 15th May. So just that like a month extra getting. And we have the list of certificates and that we have sort of sent to us. Timelines to issue TDS certificates. Again, just one point sometimes that we end up missing out is formally this is required to issue TDS certificates. So while of course 26 AS reflects it and that normally is sufficient now, but in case of a default of not issuing TDS certificates to vendors, there can be criminal consequences. So, as good order, it is of course it's always better to do this. Form 15 CACD for all non-resident payments, sums chargeable to tax as such. Prior to remittance itself, actually AD bankers insist that we submit Form 15 CACD to them. Something that we would have come across, again we have 4 parts. Part A is when income is chargeable to tax but then doesn't exceed 5 lakhs. Part B comes in when there is a no deduction certificate. Part C is when there is a 15 CB and the CA certifying it. And part D is when the entire amount is not chargeable to tax. on this basis is where the remittance happens, and then of course these details are handy even when we have to file the TDS return. Yes, stop please.
Here, if a payment is made to NRO account,
Okay.
whether CS certificate and amount is more than 5 lakhs.
Okay, I understand what you say. See there, no, I would, you're saying then the AD will not ask for it, it's going to be in an NRO account, it would still make sense for you to
As
do
per
it.
section. Yes.
It would make sense for you to do it, yeah.
But there is a guidance now from issued
Okay.
where it says that it is not required. But I am not able to find any legal basis.
No. So we get these questions, I'll tell you this comes a lot. I'm paying rent to my landlord, but my landlord is a non-resident. Do I have to file 15? Do we have really a basis to say don't do 15 CSEB? It's still, the fact that it's an INR, the fact that it's going to an Indian bank account doesn't change the fact that his residency status is still that of a non-resident. So not really recommended unless you have something.
The logic given in the issued guidance is when NRO account from funds are being transferred from NRO account to other account outside India, then again he has to submit 15 CSED. That's what the logic is. So it is so the same transaction duplication is happening. So that at a first stage it is not required. That's what logic was given in the issue. But I would not feel that
No, I wouldn't think so. Because I think we have to look at it from that deductor's point of view. If he's either going to do a TDS or just the fact that the status of that person is a non-resident, there's nothing that the Act allows us to venture otherwise into. So yeah, I can understand that it's double, but then that's unfortunately what it is. Same.
Even in property transactions, when we are buying from an NRI, and the payment is most often made through the local NRI, but there's no 15 CSEB there.
So that again, so the thing is the AD will not ask for it, but under the law, what do I have that's exempting me from doing it to the point? I just have to look at residential status and see if the income is chargeable to tax. If my 195 is triggering it, then I don't have an option really to not withhold or not file these forms on is what I'm trying to say. So we generally wouldn't. I mean, completely understand that this question comes up saying, where is the requirement, where is it? No.
So I have deducted a higher tax rate, but I did not file the forms. What are the consequences?
If you have deducted it, but you have not filed for
15 CA.
I frankly I'll have to recheck. I think there should be some. I'm not recollecting offhand. There could be like a penal consequence around it, but I think you saying there is nothing penalizing me under the Act, so
No, I don't know. I am not aware. At least
no, I would also. I think I'll have to check if there is a penalty.
There is, I don't remember the exact, but if you don't file forms.
Forms, then there is something that's mentioned in section 195 which says that you still file.
So in the 270 series, there
There is one for.
is something.
15 CB, I think again we're aware, is a certificate, CA certificate that we obtain, sort of for the withholding tax liability. In case it's taking the TD rate, YALC form 10F is like a must. We move on to practical considerations, section wise. Okay, now on 192 TDS on salaries, I think something that we observed is that after 17 to 7, 17 to 7A has come in, for some of the senior employees in organizations, the contribution to Provident Fund happens to be more than 7.5 lakhs. So that information has to be built into the Form 16 and TDS has to be done on that incremental value. So that is one thing. And also the interest component on that is something that has to be factored for TDS. Obviously, one option is that we can ask, that employee to give the passbook and factor it. If not, then, the better way would be at least to do an estimate of what that amount can be, which is the formula that is prescribed at the section 17 to 7A, and withhold taxes. So, on the taxable component of, the employee's contribution in excess of 7.5 lakhs, while it's not a cash payment to him, but 192 comes in, and the interest on that also is something that comes in. Again, something we've seen being missed out. I think the third point we've discussed, saying that if there are any other details of any other income or say TDS as such, then that can be given to the employer and the employer can factor it for the purpose of doing TDS. The excess deficiency can be sort of made good through, within the year. And of course, we have the fact that we are aware simplified tax regime is the default tax regime, so that's where we deduct it. We don't get any sort of input from the employer.
That interest is getting TDS and other sources, right? So why
No,
is
there are
the
two
employers?
There are two components actually. The TDS on other sources will be for employees. Employers will still have to do.
But the employees will not give us the status.
You can, I can understand. Actually, what we do is then we drop, at least like from your side, you would have, like for good order, you would have done it. Because today it's coming in perquisite, then where do you have an option to not factor it? No, that's what becomes the challenge.
So interest also will be included in perquisite. So in that case, many cases you would have missed out the interest, no? Because only the employees participating in one next for a.
Correct.
So they would have missed out. So what precautions we can at least tell our companies
To do. It will be good to see check with them that one is this much I can tell you from experience that it doesn't come out to be a very significant number if you look at the TP formula. What you can do is one is you can check with the employee if he has done. I think if that way it's happened, then at least you are protected because he's filed the return. But on a going forward basis, you can estimate it a little bit.
Or else you get a declaration.
Sorry.
Get a declaration.
No, yeah, they not do it. Again, because the point is, if you privy to the taxable contribution, then what case do you have to say, I don't know what the interest on that
Rates
is?
of interest.
It should still get computed by the formula. I mean, TDS on dividend payments. So 10% applies if the recipient is a resident shareholder. For a non-resident, we have to look at 195. So just that residency status has to be tested. And also the fact that dividend here includes all dividend under section 222B. So if there is a risk of any item being treated as a dividend in the hand of the shareholder, there is an equal risk of a withholding tax non-compliance or a compliance in the hands of the employer also. So yeah, this is something to be cognizant of when we are taking any positions around whether an item is deemed dividend or not. 194C payment to contractors. Again, I think briefly we sort of discussed what it is and the fact that work is an inclusive definition. So, I mean, in general sense, any positive act that is being done can, in common parlance, be understood to be work, and TDS should apply there. The definition is inclusive, so anything apart from those categories also gets hit by section 194C. I guess there are a couple of questions that are very common here to say that what is a works contract versus what is a contract for sale. The general jurisprudence or the general guidance that we've seen is that if you're manufacturing as per any person's specification, but the ownership of all material, of everything is with the person who's customizing is with the vendor, then even if you finally give it to the customer, 194C should not apply because that then tends to lean towards more sale of goods. And of course, the fact that manufacturing per specifications of a person is specifically excluded if the material is supplied by somebody else other than that person or the associated enterprise. So that's one point. Then one thing that we've seen coming in 194C quite a bit is what do we do with composite charges, warehousing, logistics, warehousing plus logistics plus handling plus management plus 2 people managing the warehouse. So I think it becomes again very tricky because what are traditional definitions of rent and traditional definitions of warehousing has kind of evolved now under the new business models. So of course the best is for us to have a demarcation if the client is insisting that no, this should be a 2% and why is this rent and this should not be a 10%. Also, sometimes we see arguments to say that it's a warehouse thing charge that I'm paying, but it's not like I have access to the whole warehouse. But I think so long as you still have some right over, say, a part of, say, a few shells or something, you can still get hit by, the definition of rent. So, if of course we're looking at a lower than a 10% tax rate for some cases and say if it's a mix and match. Normally in warehousing what we see is that there will be some bit of a store manage or other warehousing management also, because there will be a couple of people say using a software to manage inventory. There will be a couple of people who will be moving inventory out, moving it in. So for all of those, I mean it's best to have a demarcation and then pick and choose as to which rate should be followed. So yeah, that's something that we sort of have to see. I think also one question here comes is, also one question that comes here is that advertising and sales promotion, I think as per 37.3 I think at the time it was, are different items. So if there is an item that falls more in the, along the lines of sales promotion, then it is possible to still say that it is not advertising. We generally end up, sometimes what happens is because of course there are so many TDS sections we have that ends up fitting something. But if it's a pure play business promotion, sales promotion, then 194C also is something that we can come out of, provided we can clearly distinguish it from advertising. Um, 194H for commission and brokerage. So here this is, like we said, for any payment, receivable, directly or indirectly, by any person acting on behalf of any other person for services rendered or goods. So I think here as well, because it says principal and agent relationships, there are a lot of items that become critical to see if it is in the nature of commission or not. For instance, say, we have that typical SIM card scenario where we say that, there is a buy-sell model where there is a distributor, the retailer is buying SIM cards and then selling it ahead in case of margins, which sort of, whether it will be a commission or a sale of goods will again depend on the amount of risk that you are really bearing. If it's a buy-sell, which is or rather if it's a commission, camouflaged as buy-sell, then we do now sort of see the department trying to take the view that it is more in the nature of commission rather than discount. Sorry, go ahead. No, so again, I think that's something that we've seen even in case of discounts. What happens is if it's like a cost plus a certain margin model, but effectively the inventory risk or the market risk, or if it's more like a JIT kind of model, then we kind of start leaning towards the position, or rather it then becomes really important to see as to whether what we call as a discount can then come as a commission. So that's something to be cognizant of when we see commission.
So I had a question here.
Sure.
In these evolving business setups, you now have some, in the fintech space, you have a lot of these credit platforms, right, who allow you to sell your receivables and things like that.
Okay.
Now what happens is some of them pure play escrow accounts, that's what they're doing. They're saying, I just hold the escrow, you deposit here, that person will take from here, I'm just doing this, there's no service I'm giving. So it doesn't get hit by any of the sections.
But you're charging a fees for it?
Yeah, platform.
Okay.
But effectively, their argument is this doesn't come under, none of these sections apply. So I was trying to see whether it will even come under 194H, because it says, or for any services in the course of buying or selling of goods. Because I effectively have sold this, and that invoice I'm trying to collect, and in that process, this guy is helping me with the escrow.
Correct.
So conservatively,
yes, even otherwise, I would think, even not conservatively on a fee today, like I would counter, I would say, why is it not even any form of work? Is it no service? It's still a service.
no, they are saying we are not doing anything. We just have these bank accounts, you deposit, you withdraw, whatever. We don't even do analysis of your financials. It's the buyer's responsibility. If he wants to buy your receivables, he'll buy.
Okay.
My only thing is I have accounts.
But there's not any charge.
Yeah, no, that's the position they've taken, and in fact they've got a clearance from one of the consulting firms to say that no, these sections ought not to be applicable. But we were in the practical side as a deductor, we were like, listen, I'm looking at a 201 notice now.
Correct.
So my sense is it should come there, right?
But,
in the fintech space, at
yes.
least at least 2%. Forget about C, H now, because like you said earlier, the classification between C and
H and J.
Even if I say it's just a platform and 2%, still should do a 2%.
I could, in fact, if I were to counter it, say, isn't it like an incidental usage of platform? I mean, then can't I even get hit by that? And saying if I'm trying to counter, like a withholding there, I would say, so one is commission, like you said, because it says it's very right to say any service in the course of buy and sell, and that's where we practically also see a lot of companies take a position that if it's a buy sell related service, it is hit by 194H unless you are getting into something more specific, like a logistic or a freight, where again it goes more specific rather than a buy sell related activity. So 194H most of these payments get hit by. But then I think if you're probably trying to argue that isn't like this also an incidental usage of the platform if they are somewhere then if that's what they're using.
Then
But where does the principal agent relationship comes into the picture in this platform usage? See, it very clearly says that, right? Commission brokerage comes into the picture only if there is a principal agent relationship.
So fair enough. So there also we can say it gets. So then it will go into any one of the. So what again? I'll tell you. So practically, so what we've seen is when of course when this was this 5 versus 2 sort of controversy. The companies that took a more conservative view said that we'll do 5% and we close it. Some of them who wanted to come out of it and say, no, I still want to hold on to a no principal agent relationship, which is also a fairly valid argument because for that matter, anybody who acts, how would I say it? Say somebody who's doing like a cash collection on your behalf, or somebody who's collecting goods on your behalf, you can still say that he's not representing me or he's not holding out to be my representative, but he's providing a service to me. And therefore, why should I get hit by H? I should get hit by a C or a J. So, I mean, we can come out of that and, probably it has become more conservative, but you would still get hit by a C or a 2%. I would think it still says some form of, work. How do I say that? It's none of the other sort of sections there.
One practical example I can quote is from one of the hyperscalers, cloud service providers. We are conducting under 194J, technical services.
Yes.
So these platforms, maybe not as big as Azure or AWS, will fit into that block of technical services.
So there, if it's access to platform, this one thing is royalty is not something that we can look at, 10%. Because that could also come. So the only challenge with admitting an access to a platform or a server or an IP is then the department will start leaning more towards royalty and say why even FPS. So I think if it calls out platform usage, then maybe the risk is more towards 10 than even a 2 for that matter. Okay. So 194H. Fees for professional and technical services. Technical services, of course, is 2% like we're aware. For everything else, we sort of have a 10. So professional services gets hit by 10. If say we have any remuneration commission fees to a director, rather than that falls under salary, that also gets hit by the 10% section. And non-compete is also something that's covered here. Now, professional services are defined more exhaustively to include certain specific provisions. So it says legal, medical, engineering, architectural, professional accountancy, technical consultancy, interior decoration, or advertising. Advertising, interestingly, comes in C also and comes in J also. The CBDT circular that came out for both of these back in 1995 said that when the payment is made to an advertising agency, then we get hit by C. When the advertising agency pays it to the professionals, is when we get hit by J. So that's the distinguish that was brought in. Becomes I think a little more, some of these business models are more emerged now. So, traditionally who are professionals aren't professional, like we get queries like what to do with the social media influencer, does that fall under the C versus a J? But I think largely, as long as we are not falling under the prescribed professions, we should be good to say, out of profession as a technical service. That's the way that we do. And yes, again, just that one key point that we also wanted to bring in is that when it comes to software platforms, usages, these other activities that don't require a human intervention, then most times it ends up getting hit by royalty. So while of course companies come back and say, why are you making me do 2%, it's not professional, but then we get hit by usage of software, let's say usage of a server, or those items when we have to then fall back on to 10%. So. Now, Section 194R, again introduced in Finance Act 22, talks about benefits and perquisites arising from the exercise of business or profession, and the rate of tax is 10%. Of course, when it came in, the idea was that benefits or perquisites in kind that are there for 28.4 is what get hit by this, by this section, and TDS at 10% applies. Subsequently, over the next couple of years, the scope of 28.4 was also expanded. 194R also started talking about TDS on benefits or perquisites, both in cash and in kind. So, while under 28.4, which is like the base section, which 194R pertains to, or which has basically led to withholding under this section, traditionally talked about benefit or perquisite in kind, and at the time we had the Mahindra & Mahindra Supreme Court ruling to say that a loan waiver is not a benefit or perquisite because it is not a benefit or perquisite in kind. But then 28.4 was amended to say cash plus kind benefits, and of course 194R also talks about cash plus kind benefits. The most critical thing that we've seen here is that what is the benefit and what is the payment for service. Like, when do I say that I'm incentivizing someone for working, and when is it that I say that this was under a contractual obligation that I'm rewarding a person? So that's generally the key question that comes under Section 194R. There were a couple of CBDT circulars on this, which as such tried to remove difficulty and provided an exhaustive list of questions. So we'll just go through those. The first question is it necessary for the deductor to check if the amount is taxable under Section 28.4? Because 28.4 is the section that 194 arises out of. Here the CBDT clarification is no. Now, traditionally the way that we've been looking at withholding tax is to say that it's a collection mechanism for everything chargeable to tax. But in 28.4 and the CBDT circular on 194R says that I do not have to look at taxability. So that argument that we would take that because this sum is not taxable in the other party's hand, I don't have an obligation to withhold, can then not stand good, unless we are of course contesting the circular itself. So again, this is the implication, and also say it's not taxable under 28.4 if it's a remission cessation of liability, which goes into Section 41. Even then, the withholding gets hit under Section 28, under 194R. The second question on is the benefit of perquisite supposed to be kind? The CBDT circular said no, it can be both cash and kind. In fact, when the circular had come in, 28.4 still read to say that the benefit should be kind only. So, to that extent, this language of the circular, was more ultra-wise the Act itself to say that when again I don't have a charge of income under 28.4, then why should I be mandated to withhold taxes under 194R? But then of course, this clarification came, 28.4 also got amended, and then it became necessary to withhold taxes on both cash and kind benefit. Even if the benefit is in the form of a capital asset, 194R applies. Again, one thing that we see is free of cost assets. We see it in the case of GICs, we see it in the case of group companies, we see service arrangements where we say there is allocation of say a software or say there is an employee sharing arrangement between group companies and one of them is not paying the other, it could get hit by 28.4 and 194R. So while it can be taxable in the hands of the company who's getting the benefit by getting an employee without having the charge, it can also get taxable or can be hit by TDS under 194R. So this is one again implication that we see here. Again, what becomes important is that again the fact that benefit and perquisite are very wide words. Typically in a third party arrangement, if at an arm's length, if two parties are able to negotiate, one party is able to negotiate a better term or is able to probably come out of a situation paying less or having a waiver of anything, then there are still arguments to say that I transacted at arm's length and therefore there is no benefit, but then the scrutiny is much larger when it's related parties. To say is one company, between two companies, it has one gotten benefited at the cost of the other, and then this comes in. Benefit or perquisite as such can be very wide. It can be a better credit period, it can be a lower than fair value transaction, which potentially doesn't even get hit by a 48(2) because it's not excess or unreasonable, but it is so low that I didn't have to pay for something. I would still have to look at that. So just something for us to see. If something is not, if a transaction is not getting hit by, is not complying with arm's length and such, then 28(4) and 194 are have become critical now.
Sorry, I don't have complete visibility on this, but you said even if the parent is paying, let's say the parent is paying an employee and that employee is contributing towards the subsidiary's work also, right? Now, what happens in a situation when the parent is issuing ESOPs to the employee?
You should have a charge. Otherwise, you will get hit by 28(4). I mean, primarily, you can look at, so you can say, I'm a cost plus. All of that are arguments that you build in.
But if you are saying there is a risk.
I would say there is a risk. Because why is this not a benefit? Because it has the Act's not defined benefit.
So you're saying if there's no cross charge, then there is an open risk.
You could still have. And unfortunately, Bangalore ITAT is not very favorable on it. There is HP, there are 3 rulings there in succession. I'm missing names. HP is definitely one of them. It was a case of free of cost assets from the parent to the subsidiary for testing, you remember.
Yes.
They said if you not returned it, then it's still a benefit. What we see is that even for that matter, services are not very different. No, if I'm benefiting your employees, they're still working for you. I'm not charged you anything. Can the tax officer not come and say that it's a benefit? ESOP cross charge has become tricky actually after this, yes.
So in this transaction, holding company issues a shares to the subsidiary employees. So if holding company cross charges back to the subsidiary company, then no 194 are used.
I'm saying, so I'm saying if holding company is cross charging back to subsidiary, no 28(4). Of course, see this is still more exploratory debatable because we have judgments both ways. But yes, there is an exposure of potential because my holding company has given an ESOP to my employees. I am being benefited by the services of those employees, not my holding company. If I don't have a charge, then can that not become a benefit?
Benefit is for employees, no subsidiary employees.
No, for you, no. That way, it's the same. So the reason that we claim a 37 reduction of ESOP is because we say the company gets benefited because of options. So it's the company that gets benefited by the services of the employee. So therefore, 28 for 194.
Companies that take their dealers and distributors for having met their sales targets, they take them on a trip sometimes. So that come under 194.
Yes, I think there again, CBD circular is specific about the fact that if it's a conference, which is something that we do see company sort of call it as, across dealers, say it's a more uniform trip and training, it's a workshop, then we can come out of it because the circular provides it. If it's a pure leisure trip, it will get hit. That's it. Get something to the mind. And that actually, so that became a huge industry issue after this actually came in. And the unfortunate part is that, that the company also becomes out of pocket if they have to discharge this liability, right? Because it's a benefit in kind. And then I would think in all probability the dealer would not be reporting it. Now, after you do a 194, he is also obligated because he will have it in his property. So, a lot of issues around that. We have this covered. Whether sales discounts, cash discounts, and rebates are benefits of purposes. The simple answer is no. Sales discounts, cash discounts, and rebates are not. The challenge that comes is if a discount is given post sales in the form of a credit note, then does that become a benefit or is that not a benefit? Again, companies try to argue that it is a discount. I meant to give it as a discount. But then the other argument is that you actually wanted to pay that as cash, but you have given it as a credit note so that you're sort of not hit by these provisions. So while it eventually, of course, results in a reduction of the purchase price, but that is also a position that could get questioned. for the reason that discount is something that we perceive as something more instant, like based on say the volume, if you paid less, gets hit by discount. But if it's a like a post facto benefit or a post transaction benefit, then this exposure sort of comes back. Yes, how is the valuation of benefit to be done? Again, I think this guidance is more basic to say that where the provider has purchased it, then the cost of purchase. When the provider has manufactured it, the cost of manufacture. Some things might get a little trickier. Say in the case of that HP ruling, if I get equipment from overseas and I'm using it, assuming they are laptops, if I return them, how do I quantify the value of the benefit, if at all I have to? So then do I say, and typically what would happen is in computers, if by the time you return it, they're not really in a condition that can be put to use anymore, can I still say that the entire cost of the asset that I got could be benefit purposes? So as it becomes like more intangible, a benefit could be in terms of a better credit period also. Instead of 90 days that you give between arm's length at to parties, you do a 30 days if it's for your related party. Then how do I quantify benefit purposes? Also in a way that while I'm quantifying the benefit, but I'm not getting into an opportunity cost or a notional benefit also. So I think there are quite a few issues around 194R that since it's coming, we'll get to it. We have those questions also. Then are products given to social media influencers for speaking about the product covered under benefit purpose? If the product is returned, no. If the product is not returned, yes. Whether reimbursement of out-of-pocket expenses benefit and purpose? The simple answer here given is yes, to say that the genesis being that it is the service provider's responsibility to incur the expenses. If he has recovered it from the service recipient, it is a benefit. The only exception is that if this arrangement was, if the service provider incurred this expense as a pure agent and the input tax credit is taken by the service recipient, then 194R doesn't apply. It comes in the second circular, but as such out-of-pocket expenses now get hit by 194R. How can the deductor be satisfied that tax has been deposited under section 194R, where benefits and perquisites are in kind? I think the first option here is deductor may rely on a declaration and ask for a copy of the advance tax challan. The counter here is what if there is no tax liability. There could be a situation where the person that I've given the benefit to may not have a tax liability. In that case, whether like a pure play declaration can be relied on or can this be read down reasonably will be a question. And the other way, of course, is that the department recommends that we gross up. Again, adding to the cost, and then the tax becomes a benefit also. This is the one on dealers conference, which says that in case of a dealers conference with the prime objective of educating them, in such a case, the conference is not a benefit or opposite, and of course there is criteria as to what is the conference supposed to be about. So it says a product launch or a discussion on how product is better, obtaining orders, teaching sales techniques, addressing queries, reconciliation of accounts, means anything which is more work-driven, educational, it doesn't apply. They've carved out a couple of, one again exception is, if this is an incentive trip, it gets hit by 194R, which means that if there is a large dealer network and some people are being taken on a trip only because they have achieved a target, even if they are trained, it would still get hit by benefit or opposite because it's based on the target that they have achieved. So some of these things can be extremely subjective, but then they have been called out and as many words, so something to be cautious of. Again, one practical scenario that we faced was we had a client that had a lot of contract employees, and of course, contract employees, you don't have an employer-employee relationship, and they were taken on an offsite. Now for that, what do we say? It will be a pure ledger trip, and on that to ask them to do 194R becomes tricky, but then yes, that's a valid question that comes in as to what do I do with that. Similarly, if say, there are contract employees and there are cash advances given to them, say to incur their day-to-day expenses. So a company could have, or rather, a business could have multiple branches, it could have contract employees. across there and say if you have an impressed cash of 10,000 to them. As such, it's a service provider providing services to a service recipient and you have reimbursed them for out-of-pocket expenses. So for that also I get hit by 194R. And therefore on that impressed also do I have to do 194R. Couple of clarifications here. Expenses attributable, sir, as you were saying, to leisure is clearly called out as benefit, and expenses incurred for family members is also called out as benefit. Overstay is also benefit. So I think we can be very granular in this.
Sorry, this one thing.
Sure.
You mentioned about contractual employees. So in that case,
So any expenditure that I incur on these contractual employees gets hit.
Unless the invoice is in the name of the company.
Which invoice? So
For example, you explain us that I'll do this.
So for example, now a lot of these MNCs don't take the employees on board, right? They'll have it to a third-party service provider, and the third-party service provider at the end of the month will send them a payroll invoice. I'm just paying for that. It goes under 194CJ, whatever it is. So I'm deducting on that. But while they are in my office, I might be paying for their food, their whatever, travel, etc. So that I may not cross-charge to the payroll service provider because I have a shuttle that's going daily to the metro, say. I have a canteen service which is there for the whole, the whole company or the whole office that is there. Now, how do I bifurcate that? And then that also gets hit by 194R?
It can, no, because in a way, if you go by the service provider and the service recipient logic that they spoken about, we are trying to say that it was expenditure incurred in the process of providing services. So therefore, it should have been.
No, they are providing services.
Correct. So they are providing services to you. So we'll talk to them. We'll talk about them as service providers.
They are my service.
So these expenses that they've incurred, for example, in an audit, out-of-pocket expenses on lunch, frankly, it's as good as that, right?
No. So I'm saying that I am incurring.
You are incurring on them. If the invoice is in your,
I am a contractual employer.
You know contract.
So let's take an example. I'm just randomly saying Oracle.
Okay.
Oracle employs a number of, let's say, finance professionals through a CA firm.
Okay.
The CA firm is outsourcing them to me. At the end of the month, I pay the salary to the CA firm. CA firm will distribute the salary. I have nothing to do. They just come to my premise, sit here and do my accounting. But while they are sitting here, I am giving them benefits of the food, of travel.
That is fine.
Which I am not paying them. I am not charging it back to the...
That is fine. What is not fine, I'll tell you. If they are having lunch, the invoice is in their name, and if you are reimbursing it directly to them, then it is an out-of-pocket expense of a service provider that you are reimbursing. That's what gets it. This will not. Because
I am incurring on my own penny.
Yes.
I am making sure that they are comfortable. I am not... It's my expenditure.
It's your expenditure.
It doesn't become benefit in their hands?
No, the invoice is in your name because...
Yes, it's all my setup.
It's not a benefit. It's not a benefit. It's your business expense.
So they're coming here, they're giving me service, but they're benefiting.
So we just go back. So the genesis, I'll tell you of that.
They might get gifts if there's a function. You understand what I'm saying,
Correct.
right? If Diwali hai, whatever. They, as part of the rec, because see, they will not differentiate कि ये contractor employee है, ये मेरा employee है. So it will be like a common thing.
Correct.
If I breach that 20K somewhere,
No. I'll tell you the reason why is because the reason we're having this conversation is because we talk about out-of-pocket expenses. These are not their out-of-pocket expenses. So what the circular says is that if a service provider has incurred expenses out of pocket and if you are reimbursing it, then it is a benefit to them. Because they should have incurred it on their own account in rendering you services. This does not get it by that. But unfortunately, the others, if you treat them maybe equal and they spend somewhere and they put a claim, that's where it gets hit. So the practical way to address it is to capture it in the invoice. I mean, that's at least what we've been doing. If it's a C, at least then it gets hit by 2% versus a 10%. I think this was very important. Now, of course, after the first set, we created a lot of confusion, there was a second set of it. So this is the second set of security clarification. Taxability in the hands of the recipient says that it is being clarified that the taxability is not going to impact 194R. So I just have to look at whether I think I'm giving a benefit. It becomes a little tricky. We come to those examples later on as to what do I call a benefit and what do I call my contractual obligation to come to it. If the loan settlement waiver by a bank is to be treated as a benefit purpose, this question is coming because of the Mahindra and Mahindra Supreme Court ruling, because when that ruling came, it said loan waiver is a benefit in cash, therefore not hit by 28(4), and that, obviously taxpayers wanted to read into 194R and say that even 194R should not apply. This specifically came out to say that in case of a loan waiver, typically 28(4), 194R applies, but 194R does not apply if it's from specific financial institutions. So therefore what it means is that if in other than a specified bank financial institution scenario, if there is a loan waiver, the waiver gets hit by 194R, which means that if a party is refusing to pay me, then the fact that I have agreed for them to not pay me, I will have to do TDS on them. Plain vanilla TDS is how it comes across because it's a benefit to them. Interestingly, here also they said that while 194R doesn't apply on a loan waiver which is done by financial institutions, it does not impact the other provisions of the section, which means that the person for whom it is being waived can still get subjected to 28(4). So, yes. That's one challenge comes here. Some iterations are unilateral write-off of, say, like a payable. I had to pay someone. They didn't come and claim it. Barred by period of limitation. I wrote it off. Now I basically conferred a benefit on them. Do I do 194R? And how do I do 194R? Do I go out of pocket and do it? So,
how is a payable?
So I'm saying I had a payable to you. Okay?
You owe me money.
I owe you money. I wrote it off. You didn't come to me for 3 years, I wrote it off.
So I have lost money, right?
No, so I think I probably said it. So we could say the other. So for example, I owe you, right? And you've not, let's say, also the benefit comes when you write it off actually. Correct. So I get benefited when you write it off. When you write it off, the question is, do you have to do 194R?
Ideally I should. It's the same thing as a bank, but where do I get the money?
Then do you go out of pocket? That's what.
Yeah, so if they have given the benefit to banks, ideally they should extend it to others also, because I'm writing it off because I'm not getting the money. Where's the question of now me doing an out of pocket 194R, right? Practically that's
what. That's the issue. But then but unfortunately, no. I think again, just like personally, I think here the removal of difficulties have gone a little bit wider than removal of difficulties. So yeah, I think these couple of these circulars have probably read too much into the section more than actually what was even intended is how it is actually about it. So that's true. It's a double. It becomes a double whammy. Like I'm not getting paid also. Then I should go out of pocket and then do where do I do?
And then give him credit for that.
That's true. That's a practical, fair enough, that's a practical argument, we'll have to sort of take. But then I still think he can get caught. Like he can still get caught for 28(4). Maybe you cannot. What I might know.
In tax audit, I have to mention, madam, writing of bad debts, including PAN number,
You have
I have to mention.
Mention, yeah.
So that will be a track.
Correct.
So he will be getting taxed. Definitely 194R, definitely they will
They can pick up it.
No, him getting caught and him going through all the struggle is a different thing. I have to have this problem now.
Yeah.
I still have to do the compliance and everything.
Correct. See, I think practically we can go, they wouldn't go this far. But for the ambiguity that is there, again, it could come up. I mean, of course, we look at situations, we do look at this. These are issues practically that there are. Yes. If under the terms of agreement, the expense incurred by the service provider is the cost of service recipient, and such cost is reimbursement by the service recipient to the service provider, how is it a benefit proposite if the bill is not in the name of the service recipient? It's the same thing that we discussed. The genesis is, the department says that if there is any out-of-pocket expense incurred by the service provider, it is his expense to render service. Therefore, if you are reimbursing, it is a benefit to him. There is an exception only if the invoice is in the name of the service recipient, and if the arrangement is of a pure agent, then 194 hours should not come. One way to look at it is that if you look at the circular 715, and I'm missing I think 718, maybe 194C and 194J, it talks about that 194C, 194J has to be done on the gross value of invoice. So if the TDS is anyway done on the gross value invoice, then again it can't get hit by 194R. But then if we are taking a position that I'm not going to do TDS on out-of-pocket expenses, then this has to get tested, at least after the circular, for sure. And I remember we used to have these arguments to say that it's matching entirely, it's a pure cost to cost, there are backups, and you would check those supporting, but those supporting wouldn't help if the invoice is not in the name of the service recipient. If it's in the name of the service provider, you'll have to do the section TDS. This is the interplay of the the gross amount, the gross invoice amount, and 194R to say that if you're already doing it on the gross invoice amount, then you need to really travel to 194R. This is the only exception. Embassies, high commissions are exempted. This is on the dealer conference to educate the dealers about the products. Is there a requirement that all dealers must be invited? The clarification is it is not necessary that all dealers are required to be invited for the expenses to be considered as benefit under 194R. Essentially, it cannot be like, the problem starts to arise when it is called out as an incentive trip. Other than that, if there is a criteria based on which, they are inviting dealers or something like that, we can still come out. What if the dealers arrive one day before and leave one day after? So I think that the relief here is that that overstay of that one day is allowed. If it's beyond that, then the overstay then becomes a benefit of a visit. And the question of how to identify benefit of a visit in the group activity, I think the CBDT said that if you're not able to identify it, then it can get the better way is to disallow it in the computation. So, yes, yeah.
How can overstay be determined?
Sorry?
How can the overstay be determined? Like the person who's the company that's taking them can always set up some every.
So that's how we see, company practically deal with it. Yes, because it becomes very granular for them also to track, and of course there's like some form of business relationship also that they have to look at. Like they can't just be telling them to go in and go out whenever they want. So it's there.
Keyman insurance premium, whether it is under 194R?
So Keyman insurance premium. No, sir. That actually because it gets paid by employer-employee relations. So that's a reason.
For directors, there is no employer-employee relation.
Directors are using not on full-time employment. So it could get. So there actually there's one sort of a distinguishment there, sir. And that's a problem that we have. Sir, if you can still say that it is in consideration for the services that you got, you can come out. But sir, the minute it becomes over and above the service, is when it starts getting hit by R. So for instance, say today I am, let's say I've engaged a salesperson and I am saying if you meet this target, I give you this much. If you meet this target, I give you this. So, so on and so forth it happens. Sir, the point comes is that if I have contractually agreed that for these efforts, I'm going to give you this much, then sir, we can still try to say that it's not R, it's my contractual obligation to pay him so much, and I will go back to the primary section, whether it is C, whether it is J, whatever it is. So then the key one also, if you have that kind of an arrangement, that in return for this, you are getting this, be a good sir. Beyond that is where we start getting it by R.
Madam, these pharma companies sponsoring various kind of kits and other non-cash benefits for the medical practitioners. Does this attract 194R?
So that's actually one of the worst impacted cases, sir. That's what it has. So it's come to them. So incidentally, I think in 37 also they have provided like a specific disallowance of expenses not permitted under the ICMR guideline. But sir, it gets clear actually. It's a practical challenge that we see that pharma companies can't incentivize now. a couple of more questions. Company A gifts a car to its dealer B and deducted tax on this benefit under 194R. Dealer B uses this car in his business. Will he get deduction or depreciation? Calculating income under here. Sorry, profits and gains of business profession. Answer is yes. Of course, I mean after they paid, they've had a 194R, 28 depreciation obviously can be claimed on this item. Shouldn't be an issue. I think this is the one which gets interesting. Whether issuance of bonus, rights, shares is a benefit proposal if issued by a company which is or in this public is substantially interested. They have said that if there is a bonus or a rights issue for a listed company, it's not benefit proposal. The question becomes, what do I do with the quarterly? What if it's a bonus or a preference share by a private limited company? Does that become a benefit or proposal? So there what we will have to do is we'll have to see practically how it is happening. If my rights are to all shareholders, if my bonus is of course to all, bonus cost will be to say all my shareholders, then in that case, if there is no change in their proportionate rights between each other, even for an unlisted company, we can look at this position, but this is a position we will have to take because the circular is very clearly saying it's applicable to listed companies. Which means tax authorities can come back and say it's not a listed company, where is a 94R on bonus and rights shares. So this will have to be reasoned if we take a position that 194R should not apply and will have to be looked at on the basis of facts. Thumb rule largely being if the rights of my shareholders are not changing in between them by bonus or preference issue, or bonus or rights issue, we should be fine. So yeah, this is on the TDS actually section. I think we largely covered. In case there are any questions, we can discuss. Otherwise, we move to the consequences of failure. Yes.
In case of a non-resident sitting in India and earning a salary, he earns in a company base while transferring the funds from India account to his foreign account. In that case, TCS is required to be collected with it.
Okay, so I will if it's getting hit by LRS TCS, because if you see the preamble is only that, the section, if you get hit by LRS, yes.
That's already taxed into again getting tax.
That way, actually, if you see, all of this LRS is only a spend. I mean, whether it's an overseas program or it is for ESOPs also, when employees are exercising, they are getting hit by LRS there. So unfortunately, it's a nightmare because imagine paying to buy shares and all that in ESOP also. So they go out of pocket for all that. So it's a practical issue, but yeah.
In case of these technical consideration to a foreign company,
Yes.
if I have a TRC, then
Yes,
it says that if the TTA is beneficial, I can opt for that,
Yes.
provided the company is filing the return.
Yes, sir.
How do I know the company is filing the return? One, because at the time of payment, the year would have not been over.
Sir, for TRC, so for applying the DTAA rate, sir, you will only need TRC form 10F.
We are receiving now notices saying that it should have been deducted at 20% or deducted at 10%.
Sir, you have the TRC form 10 of this.
I have a TRC, but the condition says after the 2023 amendment for 115A, compulsory the return has to be filed.
Sir, that is for them. So that exemption that is there in 115A, that is for them to decide whether they should file or not.
It clearly says that return has to be filed.
Correct, sir. So,
I have deducted on the foreign.
sir, they have to claim the exemption from filing the return, filing the TDS return. Then the withholding should have at least been done at 115 rate. If it is done at lower than 115 A rate, they have to file the return. But sir, your obligation to see whether they have filed the return of income or
We are
not.
receiving no notices from this one saying that you are not deducted at 20% because they are not filing the return.
So we can say that 115 A has to be seen from the perspective of the filer. Sir, it's for him to see whether he should file return or not. Sir, actually that way, even when we are advising companies on, they ask, sir, withholding has been done on me at so and so rate, do I have to file return? We say 20% is the rate under the Act. If you have taken anything lower than that, you have to file the return. But sir, that obligation is on them. I do it based on DRC tariff, sir. So that is, I mean, very comfortable, sir. I'm not sure if this officer has become creative, sir, but yeah, it should be very fine. Move on to the consequences, it should not be much. Failure to deduct and failure to pay tax. So when the tax is deducted but not paid within the specified date, 1.5%. When the tax is not deducted, 1%. Once there is a delay in deduction, then we do not have 7th of the next month to deposit tax. Which means that if I had not done it within the due date, then and say I do it in the next month. So for example, I had to do it in April. I didn't do it in April, I did it in May. If I did it on 15th of May, I don't have time till 7th of June to deposit that tax, because if I do it on 7th of June, then from 15th May to 7th June, I'll have 1.5%. So just that's something to be sort of careful of. And yeah, the rate of interest is different. Similarly, failure to collect taxes also entails a 1% interest. 222 obviously comes in if there is sort of a delay in payment further, and for non-filing or a delayed filing, there is 200 rupees per month per day, which is the default. I think we just go to prosecution first, because we go so. One thing is that, of course, compounding has become quite, a little more open now. Only when we have, that delay in payment and not delay in reduction, prosecution is something that we can get hit by. The only exception is that if you have deposited taxes before filing the return of income with effect from given under this Finance Act, then we have a relief. But otherwise, this is not an ideal scenario to be in at all, because what we have seen is that the department has an automated system. If they identify a delay, then they come and they have auto mailers coming these notices, and of course a show cause notice of prosecution is not something that we want at all. Also, what we've seen sometimes is that at the time of finalizing tax order report, companies tend to lean to that position that let me avoid my 40IA disallowance. Let it be a delayed payment at least, but that delayed payment is not an ideal scenario, because if in the tax audit report you are disclosing delayed payment, then prosecution will be a very sort of a regular consequence then of it. So just that sort of one point to note here. We had compounding guidelines earlier. Those have gotten relaxed. There were guidelines issued on the 17th of October 24, which talked about again with the idea to reduce complexity. And earlier, while there was sort of some stringent conditions to say that you can make an application only thrice. It's not allowed for habitual defaulters. These are more relaxed guidelines. While you can of course make multiple applications for compounding, you can make a consolidated application for compounding, but still in the case of a habitual defaulter, not something that works. The compounding guidelines provide that the sort of compounding application can be made any time after the offence has been committed, either suo moto or on identification by the tax department. So this is the consequence of non-deposit, just to make note. I think when we talk about penal consequences, for tax which is not deducted or collected, there is a 271C and 271CA. Now, why is this sometimes relevant to flag is, we may be aware of Form 26A. So, we would have come across scenarios where, say, there is a 40IA disallowance and a 201 gets picked up. We go to the officer and we say, this is Form 26A, my recipient is certifying that they have deposited adequate taxes, so I should not be at default, you can levy the interest. Okay, but 271C can still come, which is penalty equivalent to the amount of default that you have done. So, what happens is, because there is that provision of assessee not to be treated in default under 201 because the recipient of income has made good the defect, 271C still can come. So just that of the consequences of non-deduction, this can become relevant. Then penalty for failure to furnish statements again can be 10,000. Penalty for failure to furnish certificate can be 500 rupees per day. Haven't really seen this getting levied, but again it's good practice to issue Form 16A Form 16 after TDS returns are filed, even though the amounts correctly reflect in Form 26. So,
If I may add,
yes.
The prosecution related what you were saying, we've just seen a practical case. So there are guidelines as to when they can initiate prosecution, and I think there's a limit of 25 lakhs.
Correct.
And 60 days.
60 days, yes.
And there they take it very strictly to say that and not or.
Or, yes.
So if you are able to bring it below that, your defaults you say that and below that, then you can kind of get them to drop.
Understand, yeah.
But if it is and, like
Then it becomes
both,
an-
then they are not. But
Yes.
yeah, we've had some.
And these arguments, or are those traditional arguments that I had a fund crunch and I didn't have money to pay TDS, haven't really recently seen going very well with department, because what happens is, if they see that your defaults are in the nature of a salary default, or you've not paid, or rather you've not deposited the TDS on salary, I think something similar to one of the cases that we've all seen, then it actually infuriates them further, saying that how did your employees file the return if you have had such a big delay in case of deposit of your employee taxes. So again, never a very good situation to be in. So actually a short deduction for that matter is a better scenario rather than a delayed payment, because from here on it's not of course surprising. Generally what we do is we also tell companies that even for your internal timeline to deposit TDS, keep 6th as the date, don't keep 7th as the date, because even if the 6th becomes a 7th, why it's not ideal to get into a scenario that you get a notice from the department saying buy even a 1 day default, because again there is an and condition.
We've got it, like it was about 2-3 crores amount, technical problem with the bank server.
Exactly.
It went the next day. Luckily the commissioner agreed for that, but
You would have planned, you still have to go and explain.
yeah, we had to do all the go through the rings, go explain about the technical errors, show the screenshot, whatever. But there they dropped. But the other one, like I said, where it's crossing 25 lakhs, and I'm not sure if it's 25 lakhs, I don't know.
It is 25 lakhs.
And 60 days, they will not.
They were not agreeing.
Yeah, they're not agreeing. And this financial crunch, you're right, it's not.
Nobody buys it in house.
It's not flying anymore.
Yeah. Yes.
See, if the non-banking finance company is not willing to give Form 26A,
Okay, yes sir.
can I take it interest certificate in place of Form 26A?
Sir, if which company not?
Non-banking finance company is
Okay.
not willing to give me Form 26A.
Okay.
So they have given me interest certificate. Can I produce it to the department and save myself?
So interest certificate stating what, if I may ask?
It's like we have paid interest to the non-banking finance company for a loan.
Okay.
So we are not deducted TDS.
Huh.
But that non-banking finance company is not willing to give me Form 26A.
Okay.
But they have already given me interest certificate. Can I show it as a proof that that company has declared income because it is a listed company?
Yes sir, it should be fine. Because of what we have seen, and again practically coming, sir, even for 26A, while there is a procedure and stuff that, of course it's become online and all, but if you can in substance prove to them that this has been offered to tax, they should be okay to leave it. Like, of course 26A would have been a better scenario for you because it's, as such, it's prescribed under the Act, under Section 201, but this should be okay. So you're saying, sir, it's a declaration of sort that saying that I have taken this income into my consideration, right? That's what is, so that should be fine. So the only, thing that we have seen here interestingly is that when they're calculating interest, sir, they sometimes tend to take a position that I will levy interest till the time that that company would have paid taxes, not till the next financial year. So for example, say if you are saying that, this income has been offered to tax and use the certificate, he'll ask you, when did you pay taxes on it? Once you substantiate that, and if you are able to substantiate that, sir, is when they will leave it and say that I will do interest calculation till the date that you as a recipient have paid taxes on this money. Filed the return or paid self-assessment tax or whatever, whichever of those criteria you put. Because we are aware of disallowance of expenditure, so 40 AI and 40 AIA, 100% and 50%, 100% in case of non-resident payments, 30% in case of resident payments. Of course, Form 26A is something that we are aware of. With that, we can come out of that assessing default. Then the liability is only interest liability. And we have practically seen, department dropping adjustments also if you're able to substantiate that I'm not an assessing default by producing Form 26A. So, prosecution we have discussed. Yes. Again, very briefly, the new bill. So, TDS as such hasn't undergone like a major change. Sorry, please go ahead.
How does the 26A play with the 40A?
So, what it says is that if you can produce Form 26A, which is like a certificate.
That is in 201.
It works here.
It works here?
Yes. The officer will drop, because here also then you are not an assessing default. And we use the physical, like not, because of course, at that, the system process of it is quite a few steps. So in an assessment we had that issue, we requested that party to give us a Form 26 and we produced it and they dropped it.
Madam, one general doubt.
Yes.
Club membership.
Okay.
So we have a clubs where the company employees are joined. They got a membership and company pays a membership, annual membership and other fees, whatever. On that, whether TDS should be deducted or not?
You're trying to take it as a business expense and not do 192. So I think that's the position you want to take, right?
Club membership, I am taking a service. As a company, I am taking a service from the club. Who employee is benefiting or not, that is different.
It's common for all. Like it's a standard. So 192.
Only top most.
No, so I guess that's where your challenge will come. I think what I recollect is that you have an exemption. From perquisite. So that membership has to be uniform across all. In your scenario, where you're saying it's for top employees, one practice what we've seen is that the company takes it as a deduction and does a 192.
Deduction okay, but membership paying for the club membership, that it is giving the services, no?
It is giving the services as in for the
company.
But for the employee will it not be a perquisite?
Okay, 192 I will deduct as a salary, but from membership, it is providing a services to me, is that case?
No, I didn't understand. So I didn't understand the leg of the question.
Okay, alternatively I will tell you only other thing. So company is entire company, they took a club membership.
Okay.
Any employee can go and take it. In that case, how?
You would still be better off actually, because then it's like an employee benefit welfare kind of an expenditure which is equally available to all. It's as good as serving tea coffee, right? If you look at it comparatively, it's not to a specific class of employees. It's generally available to everybody. It's a facility that you're better off. If you give it to specific employees, then the onus of proving the business factor of it will become very, very important, because I think it will be difficult for you to get out of 192. I have practically seen everywhere that the minute you pay something like that, tax auditor discloses it in Form 3CD, 100% disallowance they will pick up, and there one argument that used to come out is that okay, company has claimed it as a deduction, but employee has paid taxes on it, I have done 192 on it as per project. So that could be one way. If it's commonly across all, you have a better case, but for select employees, it's a very big.
I agree. 192, I agree, ma'am. But in other case, where the transaction between a club and
company. So when the payment you are saying, what is the TDS on that leg, the payment? So it's like a subscription fees. It's like a membership fees. I think you can practically take a no TDS position also. But I think okay. But it will still be say, it will be like a recreation service, or it will be like an entertainment service, or it will be better, like a 2 under C or a J 2% would still be better. Because it will be difficult to come. Okay, so I understand exactly what. So I appreciate that it's a subscription to a service, but it's still a service that it is a subscription to. So for that leg, you still have to do it.
194C.
194C, 194J all are 2% now, 194C should be fine for it. On the new bill, just to sort of summarize, there are kind of not much changes in terms of substance, it's just like a rearrangement of the sections. One thing is that when we look at section 197 of lower deduction certificate in the old, under the existing act, there are specific sections which are under which for which 197 application can be filed. 194R and 194S is excluded. The way that this has come in the, or it's proposed to come in the new bill is that all sections will get covered regardless of the nature of payment. However, the word nil certificate is not there, so there is a chance that they could practically restrict it only to lower deduction. I mean, practically even we had seen, I think you would all appreciate that, the department also moved from a 0.8 to a 0.01 or a 0.05 or higher. But under the other act, at the moment, nil is not mentioned, so department can take a view that it should be 0.2. So, yeah, that was from my side. In case there are any questions, we can take it afterwards.
But 206A,
Yes.
they are repealing it from April, right? So what happens to the cases that are still pending for 23-24 where if PAN number was not taken by 31st May, they would have removed?
They would have levied a demand.
So the demand is still there. They have not cleared it and the deductor has not linked his PAN with Aadhaar. So that issue is there. So will that also go?
No, it just says omitted actually. So we don't have that relaxation.
Oh, thank you.
So,
The company wants to take a bonus provision for the March, but they don't have the money to pay. And that money will be paid over the next 5-6 months from April to July or just before filing the return.
yes, sir.
They are going to deduct the TDS when they make the payment.
Yes, sir.
Right?
Payment basis.
And it's going to be reported for the employees, it's going to be reported in for their tax filing purposes, to be reported in 25-26.
Yes, sir.
Can the company claim this as a deduction for
Yes, sir. Sir, I would just one thing there, sir, because you've seen it, sir. If this is performance bonus, sir, you can take a view as to whether you want to cover it under 43B or not. A more conservative position is that you take it under 43B, but practically we have seen companies only taking statutory bonus under 43B and taking performance bonus outside of 43B. If, sir, you're taking a view it is outside of 43B, you can very clearly take it on a accrual basis. If, sir, you're taking it that it is covered under 43B, then you can take it on payment basis. If you anyway pay it within 5-6 months and if by 30th of September it's all in, it should not be an issue within the same year also. Yes, sir. But, sir, again, that's a bit of a, so we've seen litigation, it's a bit of a tricky position, but companies take it. They say that, what should get covered and 43B is only statutory bonus, not performance bonus. But, sir, I will also say that these are companies who have their bonus cycle such that everybody pays it before September. So they are indifferent either way. Yes,
In
sir.
the case of TDS on purchase of property,
Yes, sir.
and he has not deducted TDS, if he wants to issue Form 26A, he has to take a TAN or he has to register for taxpayer.
Sir, there actually that options that I don't think is enabled. You can try as a physical certificate, but when we see the way that this is filed actually for assessing in default, sir, it will not allow actually, at least from the system, to do it without a TAN. So if you are, sir, assuming you are defending it in a proceeding, what you can do is you can take a physical form, replicate it as close as you would want to the form that is prescribed under the Act. And, sir, frankly, if it's because TAN is not required for 194A, for this you don't have to take a TAN. You can better would be to work out with a physical certificate, sir.
Thank you, ma'am, for such a wonderful session. So I have a couple of announcements. So I would request all the members to stay back for 5 minutes. So we have a major session on bank branch audit on 29th March, where we have planned for entire day at Hotel Fairfield. I request everybody to visit the website and register for the event, and also please circulate it amongst your CA friends. We have other small sessions planned on 25th March on Excel for bank branch audit, and we have 2 sessions planned on 26th March. One is new income tax bill, and one more is on Excel for branch audit. We also have followed by the 29th March I already specified. So I would request all the members to register. And first and foremost, I would like to thank all the members for attending this session, and a big thanks to our speaker Sanjana ma'am for taking us through a refreshing session on TDS and TCS. So I would like to request our chairman CA Manjunath sir to honor the speaker with a token of appreciation. Please put your hands together. Thank you so much, members. We'll meet at next session. Thank you so much.